All right, so today is obviously it's Bank of Canada Day. We are doing our recording here on the Mortgage Life. It is September 17th. Bank of Canada made an announcement at 6:45. I usually expect it at 7 a.m., 10 a.m. Eastern time, but it was 6:45. I hit my refresh button at 6:45 and
And
boom,
drum roll.
drum roll. What happened?
You've landed on the Mortgage Life podcast, where we strive to bring you mortgage-related info that's easy to understand.
We have conversations with market experts to bring you timely updates because there's one certainty in this industry: things change.
I'm Mindy Bodwin.
And I'm Pete Solomosi. Welcome to the Mortgage Life Podcast.
What happened?
Bank of Canada lowered their rate by 1/4%. So we went from the Bank of Canada going, yeah, exactly. But they went from 2.75 down to 2.5. And that is the Bank of Canada overnight lending rate. Mindy, you had a really good point in our discussion leading up to this. So 2.5, that's the rate that consumers get. Yes? Yes, no?
No, unfortunately, no. So every time there's a rate adjustment, invariably we get a call saying, "Oh, I just heard the interest rates are at 2.5 or 2.75 or 3%. Can I please get that rate?"
No. Bank of Canada rate is a rate that only institutional lenders get. So like our banks, our mortgage lenders, those companies that borrow big sums of money, they actually borrow from something similar to the Bank of Canada or from the Bank of Canada at those rates. And then they kind of add a little bit of a buffer, their kind of profit or their operating margin. And then that's the rate that we get. So right now, the Bank of Canada has lowered the rate by 1/4% to 2.5. Most likely, we will see banks and mortgage lenders follow suit by dropping their prime lending rate by 1/4%, which would take us from 4.95 to 4.7. Hopefully, in the next few days. Sometimes it happens right away. Could be a day. Could be the end of the month.
When there's a rate increase, it usually happens quite quickly.
Yeah, exactly. This is a decrease, so maybe it'll be less quick than the rate increase. So I wanted to talk a little bit about the reasoning behind the Bank of Canada's change today. And I don't want to get too much into the weeds because obviously this is a very much a consumer focused podcast, and I don't want to lose you guys. This is a very complex thing that the Bank of Canada goes through. So realistically, it breaks down into a few factors. Number one, Bank of Canada always looks at inflation. Has inflation done anything in terms of going up, going down? Are prices more expensive today? And thankfully, inflation has not changed since last month. It has not changed since the monetary policy report in July. It's stayed at 1.9%, the CPI. So that was a good sign, and most other measures of inflation stayed the same. That means that it is within the target. I know, Mindy, you've talked a lot about the target that the Bank of Canada has, that between 1 and 3%. So we're just below half on that. We're at 1.9. And that really means that the Bank of Canada knows that it's well within the target for price stability for Canadians. So we kind of said, well, based on that, we think that that is a good thing. Number two, Canadian economic performance, and in addition to housing, the GDP declined in the last quarter. So the second quarter of the year, so April to June, there was a decline in the production of all of Canadians' businesses, and it was roughly a 1.5% decline. And that means that businesses are hurting. So they're not actually making as much stuff. They're not earning as many profits. Therefore, that's kind of a downward trend. Also tends to mean that potentially that affects labor. And if we actually look at employment, we can see that unemployment is up. So this is kind of a second factor on this. Number two is labor. There's a bit of increase in unemployment, up to 7.1%. So those things, as well as the third factor, which is the global economic performance. So the Bank of Canada will look at all the factors outside of Canada and look at especially the United States, because they influence us a lot. And they will say, well, how is the world doing? Like if they're doing really well and we're not doing well, then obviously we've got to kind of start stimulating things. The reality is the world is not doing very well either. So the the that factor, what it does is it means that no one's really doing well, everyone's suffering, and because of that they're going to try to stimulate the economy, and the stimulation comes through lowering the rate, because then businesses and consumers will borrow more money to do the things that they need to do, whether it's investment for businesses, hiring new people, or for consumers, it might mean that they're borrowing to make purchases. So that's the kind of big, broad picture. The Bank of Canada sees that things are not necessarily super rosy. And we know that when the Bank of Canada sees that there's a rosy outlook, that they want to try to decrease rates to help increase consumption. Makes total sense, right?
Right. So that sort of balance and holding pattern that we've been in since the beginning of the year has now shifted. So we've been in a balanced teeter-totter state, and now we've shifted slightly. So Bank of Canada is stepping in to try to help rescue us.
Exactly.
So
Exactly.
again, what happened? So in order to do this, Bank of Canada dropped their key policy rate to 2.5%. That's not the rate that you or I get. That's the rate that a bank would get to borrow money. But because of this, banks typically will reduce their prime rate by the same amount. So within the next couple of days, you should receive a email or letter or some sort of notification from your lender saying, our new prime rate is 4.7. So what does this mean? So every time we discuss our rate announcements, we say, those of you with a fixed rate mortgage, your rate will not change. Those of you with a variable, adjustable, or a home equity line of credit, your rate will change. So what are those three types of products? There are differences between the three of them. And I thought, you know what? We get asked this a lot, so why not actually just take a minute or two to just explain the difference? Because I think when a lot of people hear rate drop, they think, oh, sweet, my mortgage payment is going to decrease. But that's not always the case.
Right.
So in the variable rate mortgage world, the one where your interest rate changes when prime changes, there's basically two types. We have a true variable rate mortgage, and then we have an adjustable rate mortgage. So with a true variable rate mortgage, when the prime rate changes, your payment actually stays the same. But the mix of principal and interest in that payment is what shifts. So today, prime went down, so more of your payment is going to go towards paying off your principal, which means less amortization period, less time to pay off your mortgage. Conversely, if prime goes up, more of your payment goes towards paying interest and less to principal. So it actually means longer time to pay off your mortgage. So again, true variable rate mortgage, change in prime doesn't mean that your actual payment is going to change. It just means the amount of principal and interest within that payment will shift, changing the length that it'll take to pay off your mortgage.
So you bring up really good points in that if the rate goes down, your interest goes down. So that portion of your payment, the interest goes down, which means that because the payment's static, your principal actually goes up. So it's like making additional payments on your mortgage. It's like if you were to add additional payments on every regularly scheduled payment. That's kind of how that acts. And we know that when you add additional payments, that simply reduces your amortization. So that's exactly what's going to happen.
Absolutely. So it's still a good thing. It's just not, people don't see it as impactful. You know, they're like those with a true adjustable rate mortgage. So these are the folks who, when there's a change to prime, there's an immediate change to their payment amount. So today, prime, we're assuming is going to go down to 4.7. Your payment is also going to go down because the interest rate you're paying is 0.25% less, and therefore your payment will be less. So in the case of an adjustable rate mortgage, you are always paying the true interest. So your amortization period doesn't change. So payment changes, length of time it takes to pay off your mortgage doesn't change. Prime goes up, payment goes up, prime goes down, payment goes down. So what about a home equity line of credit? So not necessarily a mortgage, it's not amortized, it's basically a line of credit registered against your home, but it's interest only payments typically. So you would think that if there's a change to the bank's prime lending rate, there would be a similar change to the interest, and there is. So interest rate on a HELOC changes when prime changes, and it's an immediate change because you're paying interest only payments. So if interest rates go down like they did today, your home equity line of payment will also go down, and conversely if prime goes up. So quick summary: variable rate mortgage, no change to payment, change to length of time it takes to pay off your mortgage. Adjustable rate mortgage, yes, there will be a change to payment. Home equity line of credit, yes, there will be a change to payment.
Okay, so Mindy, what about people that have mortgages that are essentially set to fund? So like you have a renewal coming up in October, or I'm buying a house and it's closing October 15th. What about if I have a fixed rate that I've already kind of signed for and I've got it already? Does this change in the Bank of Canada affect fixed rates?
So this change today will not directly impact fixed rates. Fixed rates follow long-term bond yields. Don't want to get too technical, but they track a different set of economic conditions. Now, sometimes it does happen where if there is a change or there isn't a change, that does impact long-term bond yields. And a week or so later, lenders will start changing their fixed rates, but it won't be a direct impact like it is with those types of mortgage rates that are tied to prime.
Gotcha.
That being said, as responsible mortgage brokers that we are, and say you did have a closing at the end of this month and you have a rate of 4.44% fixed, and then we see that lenders actually do decrease their fixed rates to 4.34, well, Pete and I will do everything we can to secure you that rate, because a lot of times lenders do let us ask for those lower rates right up until closing. So
yeah,
that's the honest answer.
Yeah, absolutely.
Complicating, but true.
So if you have questions, reach out to us. Let us know what you're thinking. If you're curious about whether your fixed rate is going to be affected, if your variable rate is affected, let us know. We're happy to answer those questions. One last note on the Bank of Canada. So they concluded their statement by saying that the bank is focused on ensuring that Canadians continue to have the confidence in price stability through this period of global upheaval. We will support economic growth while ensuring inflation remains well controlled. So that basically means that they're just going to keep an eye on inflation. They're going to make sure that it stays in that target that Mindy has mentioned before, that 1 to 3%. If we're at 1.9, we're probably going to see a lot of just static. Everything's going to stay the same. We're going to stay right where we are. If it gets worse, if inflation decreases, then that may have an impact. If global uncertainty changes things, we'll see that affected in the next Bank of Canada announcement. And Mindy, when is the next Bank of Canada announcement?
Well, there's two more this year.
Yes.
October 29th, is that the next one?
Yes.
And so December, I'm not sure what.
I'm not even sure too. But I think that it'll be right at the beginning of December, because usually it's about a 6-week cycle. So October 29th, stay tuned. If anything changes, we will be sure to record another podcast and let you know. If things change in December, we'll be there. Stay tuned. Have a listen. Connect with us if you have any questions.
This is The Mortgage Life.
We look forward to continuing the conversation.
So come back and listen.